Is D-Wave quantum ticker symbol QBTS a fundamentally undervalued, strong buy riding the coattails of NVIDIA? Or is this massive recent rally a giant value trap currently flashing severe sell signals?
I mean, that is the multi-billion-dollar tension in the market right now. You have a stock where the fundamental cash burn is frankly terrifying, yet the technical momentum over the last 30 days has been completely euphoric.
Yeah.
And those two realities just cannot exist in the same space indefinitely. Something has to snap.
Exactly. And navigating that snap is exactly what we are doing on today's deep dive. If you're following this divergence, we really want to hear your take, so be sure to drop your thoughts in the comments wherever you're listening to this.
For sure.
And before we jump into the numbers, make sure you like this video and subscribe to our YouTube channel. It's basically compulsory that you leave a comment with your feedback. We want to know if you think this stock is a boom or a bust.
Yeah, let us know what you think.
Because we are looking at a massive stack of data as of today, April 20th, 2026. We've got D-Wave's comprehensive 2025 financial statements, the technical charts, the insider order flows, and some incredibly polarized analyst ratings.
It is a lot to unpack.
It really is. So let's set the stage here. QBTS closed yesterday at $21.66. Over just the past month, we have seen a 47.85% rally.
Which is wild.
Right. We're talking about an $8.01 billion market cap, massive liquidity with nearly 38 million shares, 37.89 million to be exact, changing hands daily on average.
That's a ton of volume.
And a 52-week range that just gives you vertigo. I mean, from a low of $5.97 all the way up to $46.75.
Yeah, the sheer velocity of that 47% one up in a month is, well, it's the first red flag. Or green flag, depending on your thesis.
Right.
Because when a stock adds billions in market cap in just 4 weeks, you have to immediately ask if the underlying business mechanics actually justify it, or if it is purely speculative momentum just, chasing headlines.
Yeah, totally. Because a 47% spike feels great if you bought the bottom, but hype doesn't keep the lights on.
No, it does not.
Especially in a sector as insanely capital-intensive as quantum computing. So let's bypass the momentum for a second and look at the raw numbers. The brutal reality of their fiscal year 2025 income statement, balance sheet, and cash flow.
Let's do it.
On the surface, I have to admit, the growth metrics are phenomenal. Total revenue hit $24.59 million.
Wow.
Yeah, that is a 178.5% year-over-year growth rate.
Which is massive for a hardware-adjacent company.
Right. And even better, their gross margins expanded to 82.59%. And if you look at the fourth quarter alone, Q4 was particularly explosive with $13.4 million in bookings.
That's a huge chunk of the yearly total.
It is. It's a 471% sequential jump. And the balance sheet looks robust, honestly. Total assets at $915.81 million. Total equity at $852.23 million. Huge cash reserves providing liquidity.
Yeah, and that 82% gross margin, that is the entire cornerstone of the bullish thesis here.
How so?
Well, in traditional hardware, margins are notoriously thin, right? But quantum computing isn't really sold like consumer hardware. It is increasingly sold as a cloud-based service.
Oh, like a SaaS model.
Exactly.
Yeah.
What that gross margin tells you is that once D-Wave builds the core quantum infrastructure, the marginal cost of delivering that computing power to a new enterprise client is incredibly low.
Got it.
They're basically laying down the tracks for a high-speed rail network. Laying the track costs an absolute fortune, but once it's built, adding one more passenger to the train costs practically nothing.
Okay, I love that rail network analogy, but here is where the train seems to be careening right off the cliff.
Uh-oh.
Yeah. Their net income for 2025 was a loss of $355.06 million.
Ouch.
Yeah. That is a 146.8% increase in their losses. Cash from operations was a negative $71.98 million outflow.
Right.
So to use your analogy, they're laying down those high-speed tracks, sure, but they burned through $355 million just to sell $24 million worth of tickets.
It's a tough look.
It sounds less like a high-speed rail and more like they're just shoveling literal cash into a quantum furnace.
I mean, from a traditional value investing standpoint, it absolutely looks like a furnace, but we have to understand the mechanism of scaling bleeding-edge technology here.
Okay, defend the furnace for a second.
Well, building and operating a quantum computer is not like spinning up servers for a typical SaaS company. The hardware requires specialized cryogenics to cool the processors to temperatures colder than deep space, literally, just to maintain quantum coherence.
Wow, deep space.
Yeah, the research and development costs are astronomical, and the talent pool, incredibly scarce and expensive. That $355 million isn't just operational waste, it is the physical cost of attempting to build the future before your competitors do.
But isn't there a ticking clock on that hardware? Because yes, they have high cash reserves, which provides a multi-year runway based on that current burn rate, which is the bull case.
Right, the liquidity is strong.
But in the quantum space, hardware deprecates incredibly fast. A state-of-the-art system today might be totally obsolete in 3 years. So that cash isn't just a safety net, it feels like an hourglass running out.
And that is the exact anxiety driving the bearish side of the market. It's why the market is having this huge tug of war over its true valuation.
Exactly.
Because yes, the high cash reserves provide liquidity. They can survive the burn for a couple of years. But if that $355 million net loss doesn't quickly translate into exponential enterprise adoption rather than just, incremental revenue growth, the runway ends.
Yeah.
You can't just coast on an $8 billion valuation when you were losing hundreds of millions a year on $24 million in sales. The market is pricing in a future where D-Wave owns the quantum cloud space, but the present reality is incredibly expensive.
So if the fundamental reality is that they were burning mountains of cash to build this future, you would expect the stock price to reflect some of that anxiety.
You would think so.
But it's up almost 48%. How is that fundamental battle playing out on the actual technical charts right now?
Well, it is manifesting as a violent technical tug of war. The stock is completely trapped.
Okay, let's visualize this. The stock is hovering at $21.66.
Right.
It is trading above its 50-day simple moving average, which is sitting down at $17.51. But, and this is the big but, nigga, it is stuck below the crucial 200-day SMA, which is looming overhead at $22.50.
Pinned right in the middle.
Yeah, basically stuck in an elevator between floors. Immediate resistance is yesterday's high of $21.93, and strong support is down at $20 flat.
When a stock is pinned between the 50-day and the 200-day moving average like that, technical analysts call it a lack of bullish conviction.
Lack of conviction. Yeah.
Yeah, the 50-day shows that short-term momentum is strongly bullish. Buyers have been stepping up for a month. But that 200-day average at 2250 is an iron ceiling blocking the way up.
Why is that specific 200-day line such a massive psychological barrier, though? Like, why do traders treat it like a brick wall?
Because it represents the long-term break-even point for a massive cohort of institutional and retail investors.
Oh, interesting.
Think about the psychology. If you bought QBTS a year ago during a hype cycle and watched it crash, you have been holding a heavy, unprofitable bag for months.
Just feeling the pain every day.
Exactly. As the stock suddenly surges back toward that 200-day average, you aren't looking to make a massive profit anymore. You are just desperate to get out whole.
Right. You just want your money back.
You sell the moment you hit break even. That creates a massive artificial wall of supply right at 2250.
That makes perfect sense. So you have this wall of exhausted bag holders selling at the top, which brings us to the momentum indicators.
Let's hear them.
The 14-day relative strength index, the RSI, is screaming overbought, fluctuating from 70.15 up to 88.45.
That is extremely high.
And the MACD is at 0.51, currently flashing a sell or caution signal despite the recent price rise.
The RSI at 88 is the critical metric there. An RSI above 70 means the buying pressure has been so relentless that it has detached from its standard deviation.
Like a rubber band.
Exactly like stretching a rubber band to its absolute physical limit. Even if the broader trend is up, the rubber band has to snap back to the baseline to relieve the tension.
And then you add in the MACD.
Yeah, the MACD flashing a caution signal tells us that while the price is going up, the actual speed of the buying is slowing down. The buyers are exhausted right as they are colliding with that 2250 iron ceiling. It's a recipe for a short-term pullback.
So we have this fast 47% run-up colliding violently with severe technical resistance, right when the indicators show buyers running out of steam.
Right.
That creates a highly precarious situation. So if the charts are showing this hesitation and lack of conviction at resistance, what are the people who know the company best actually doing with their money?
Always follow the money.
Always. We need to look at the insider order flow. Over the last 6 months, D-Wave insiders sold 2.2 million shares. Do you know how many they bought?
I'm bracing myself.
82.
82,000.
No, 82 individual shares.
Wow.
Yeah. In just the last 3 months alone, 10 insiders sold while only one bought.
That is a staggering ratio.
Here's where it gets really interesting, though. If the company has this amazing NVIDIA synergy that the bulls keep talking about, and massive Q4 bookings of 13 million, why are the insiders dumping 2.2 million shares and buying practically nothing?
That's a very fair question.
If you're a retail investor, shouldn't you be terrified when the ship's captains are basically selling their own stock?
It is the most natural instinct in the world to see a 10-to-1 insider sell ratio and panic. But we have to look at the nuance here. What's fascinating here is that insiders sell stock for a multitude of reasons that have nothing to do with a lack of faith in the company.
Like what?
Well, they sell to cover the taxes on their vested options. They sell to diversify their personal wealth, or maybe their financial advisors put them on scheduled liquidation plans.
Sure.
But while they sell for many reasons, they only buy on the open market for one reason. They believe the price is going up.
Okay, I get that an executive needs to buy a house or pay taxes. But 2.2 million shares versus 82 shares, that isn't just routine diversification.
No, it's not.
That is a coordinated exit at these specific price levels.
Exactly. And that is the nuanced takeaway. A 10-to-1 sell ratio at these price levels signals that even the insiders themselves might be respecting that 2250 resistance ceiling.
So they see the chart too.
Of course they do. They know their internal burn rate is $355 million a year. They see the stock has randomly spiked 47% in a month. They are taking liquidity off the table while retail momentum provides the exit liquidity.
But here is the counter-narrative to that insider selling. If we look at the short interest, it sits at 42.25 million shares, which is about 12.47% of the float.
It's a decent chunk.
It is, but the days to cover ratio is 1.0, meaning a short squeeze is highly unlikely without a massive surprise.
Right, because with an average volume of nearly 38 million shares, a ratio of 1.0 means that if every single short seller decided to buy back their stock to cover, they could theoretically do it in a single trading day.
So no prolonged squeeze for the retail crowd. But on the flip side of that, the recent large trade order flow shows neutral to bullish, heavy accumulation happening right between the $19 and $21 levels.
And that is the floor to the insider ceiling.
Okay, break that down.
This explains why the stock is trapped. You have executives happily providing supply and selling at 21 or 22 bucks, but you have massive institutional funds quietly stepping in to buy the dip at 19 or 20. The institutional money sees long-term value there, creating a demand zone.
Which perfectly sets up the ultimate debate we need to resolve for the listener.
Let's do it.
We have institutional accumulation fighting insider selling and explosive revenue fighting massive losses. Is QBTS truly an undervalued gem, or is it a classic value trap? Because the analyst ratings we are looking at are completely fractured.
Fractured is putting it mildly.
Right. Consensus from major platforms currently sits at a strong buy to moderate buy. The average price target is $37.49.
Oh, it's just huge.
That implies a nearly 72.8% upside from here. Jefferies is even calling for $45 a share.
A $45 target on a stock fighting for its life at 21 tells you how heavily some institutions are weighting the future over the present.
But wait, here's the trap. Conversely, Zacks rank gives D-Wave a number 5, which is a strong sell, citing negative earnings estimate revisions and broader sector-wide sell-offs.
Right.
And the valuation extremes are where it gets truly unhinged. Traditional discounted cash flow models, DCF models, claim D-Wave has an intrinsic value of $58.99.
Wow.
Meaning the stock is currently trading at a 69% discount. But then you run contrarian models like Alpha Spread, and they claim the stock is actually 95% overvalued, pinning its true intrinsic value at just $1.18.
$1.18.
Yes. Talk about whiplash. One model tells you the stock is worth nearly 60 bucks, and another says it's worth $1.18. That's not a difference of opinion. That's two different realities.
It really is.
This is exactly why retail traders get trapped. They see the 47% run and the strong buy rating, but they completely miss the $1.18 valuation model.
Exactly. If we connect this to the bigger picture, retail traders get trapped by momentum. They buy the hype of the NVIDIA news without looking at the fundamental downside risk of a company burning hundreds of millions of dollars.
Let's talk about that bull versus bear case. How does a model get to $59?
It does it through massive forward extrapolation. The bull case relies entirely on that NVIDIA integration, the $884 million in cash reserves giving them a runway, and actual commercial traction.
The hybrid computing thing.
Right, classical NVIDIA GPUs offshore the impossibly complex stuff to D-Wave. If D-Wave captures a monopoly-like margin on quantum cloud computing, $59 makes sense.
Okay, but what about the bear case? The $1.18 reality?
The bear case points to the $355 million in losses, the inability to break the 200-day SMA, and the immense downside volatility. It assumes the cash burn will crush them before the technology becomes a daily enterprise tool.
So bringing all these metrics together to give you a clear lens on the outlook, let's look short-term first.
In the immediate short term, we should expect consolidation around the $21 level as that RSI rubber band cools down. It needs to absorb the volatility.
And the best-case recovery scenario.
The best case scenario is that the institutional buying pressure absorbs all the insider supply, cleanly breaking that $22.50 resistance. That ceiling becomes a new floor.
And the worst-case continuation lower.
The momentum dies, the RSI snaps back, and the fundamental cash burn unresolved simply scares off new capital, sending it crashing below support.
Looking further out, the long-term outlook really hinges on the commercial rollout of their Advantage 2 system, right?
Absolutely. That next generation system is everything. And whether the broader tech sector can end the quantum winter and start actually buying this stuff at scale.
And I do need to pause here and explicitly state that this debate and everything we are unpacking today is purely an analysis of current data. It is absolutely not financial advice.
No, definitely not. Do your own research.
Always.
Yeah.
But we do want to hear your research, so again, remind you to like the video, subscribe, and drop your thoughts in the comments. Are you bullish or bearish?
Because the true medium-term catalyst, the thing that will decide the winner of this tug-of-war, is the upcoming earnings report on May 7, 2026.
That is the cliffhanger right there.
The market expects an EPS of -7 cents on $4.22 million in revenue for the quarter.
We know the May 7th earnings call is the ultimate battleground for this stock. It's going to be wild.
Oh, the volatility will be off the charts.
Which leaves us with one final provocative thought for you to explore on your own. We know the date, we know the stakes, but where is the smart money actually placing their bets right now? Would you like us to open up the option chain for May 7th to see the real story?